Hi everyone. I'm sorry I'm not able to make it to the Marcus & Millichap Kabani Hotel Group's 6th Annual Hotel Investment Forum in person. Unfortunately, I had another commitment I couldn't miss, but I do want to share a few thoughts and insights on where I see the economy and the hotel sector going through this video. Before I get started, I do want to commend everybody in this room for your perseverance through what was one of the most challenging business climates the hotel and hospitality sector has ever faced.
Here in Miami Beach, and this weekend, visitors will be packing up and getting ready to leave. That's because a new order is saying that hotels must close by Friday night.
The pandemic created severe headwinds that challenged even the most seasoned operators, but I believe your perseverance and commitment has already begun to pay dividends, and the outlook for the sector remains optimistic. The first thing I want to focus on is the top question I get from investors all over the country. Regardless of property type, are we in a recession? The answer, according to most economists, is no. We have had 2 quarters of negative GDP growth, but that in and of itself doesn't create a recession. Economists are still forecasting growth in the second half of this year, but as we go into 2023, the risks of a recession do rise. From what I'm seeing, most economists are expecting a recession in 2023, but there's a lot of debate about when exactly that will happen. Perhaps in the first part of the year, perhaps in the second half, or maybe during the summer. But the consensus is that it will be a mild recession, nothing like we saw in the global financial crisis or the pandemic. There's a great deal of uncertainty because this recession will likely be the product of Federal Reserve policy rather than outside forces, and we're still getting an understanding of exactly how that will all fit together. The good news is that we're entering this cycle in a strong position. Job formation has been quite robust. We've fully recovered all of the jobs lost during the pandemic and then some. So far in 2022, the US has added 3.8 million jobs, and it looks like we'll surpass 4 million by the end of the year. The greatest challenge is and will continue to be the labor shortage. Currently, there are 4.3 million more job openings than there are people looking for work. This labor shortage is driving wage pressure, adding to inflationary challenges. This has been particularly true for the hospitality sector, where there are currently 1.4 million job openings. That has made it particularly difficult for the hospitality sector to fully staff operations and meet customer needs. It has also put disproportionate pressure on leisure and hospitality wage growth. The wage pressure has begun to ease, but it is still dramatically outpacing the 5% US average, with leisure and hospitality wages rising 7.9% over the last year. That's down from a peak of 13.3% set earlier this year. This will be an ongoing challenge for hotel operators. Some are dealing with it by reducing their available rooms. Others are using cross-training to develop their talent of their existing staff and increase their operational flexibility. And in some cases, operators are building capacity through automation and technology. But wage pressure is one of the most significant forces driving inflation right now, and inflation is the greatest challenge for our economy as a whole. Headline inflation is currently 8.2%, and it has been relatively stable for the last several months. Core inflation, which excludes the volatile energy and food sectors, is currently in the low 6% range, and it has also been pretty stable. Although they've been stable, both of these measures are still very, very high. The Federal Reserve wants them to be in the 2% range. And because they're so high, the Fed is taking aggressive steps to curtail inflation. The Federal Reserve has raised rates 5 times so far this year, and we expect them to raise them 2 more times. They raised the rate by 75 basis points in June, July, and September. And based on the Federal Reserve statement following their meeting on September 21, and a couple of economic data points that have come online since then, we expect the November rate increase to come in at 75 basis points. That will be followed by a 50 basis point increase in December. That will take the overnight rate to the 4% to 5% range by the end of the year, the highest it's been since 2008. At the Federal Reserve's last meeting on September 21, the Fed also commented on the need to raise the unemployment rate to 4.4% next year. For me, that's a bit of an alarming number. It implies that the Fed will take action to reduce the open jobs overhang enough to begin pushing companies toward layoffs. To hit a 4.4% unemployment rate, the economy would need to lose approximately 3 to 4 million positions. First off, I'm not sure they're going to be able to do that. But more importantly, if they do, it will force the economy to a much weaker position. The Federal Reserve is having a very difficult time getting inflation under control because they really only have one way to slow the economy down, and that's through rate increases. The problem is that the underlying challenge the economy faces and the key thing driving inflation are supply chain issues and the abnormally high level of savings. Retail sales now stand more than 20% higher than they were before the pandemic, but our trucking and shipping capacity is still 0.5% below pre-pandemic levels. As a result, our supply chains are simply not moving enough goods to the marketplace to meet consumer demand, and thus supply and demand are out of alignment. In addition, total savings, the amount of cash people have placed in savings accounts and money market mutual funds, is $5 trillion above where it was before the pandemic. The exceptionally high savings is blunting the effects of raising interest rates. Basically, people don't have to borrow as much money right now because they have cash in hand. Some things like housing do require lending, and those sectors have slowed down significantly. But in general, consumption is not being restrained by the rising interest rates, yet. I've modeled out my best estimate on the burn-off of savings and anticipate that by the end of 2023, savings levels should be back in alignment with their normal trend. As we approach that point, we'll start to see the real bite rising interest rates will have on consumption. That's where I expect to see a correction that should substantively slow inflation down. Before I move on, I want to take a minute to put the interest rate levels in a broader context. Right now, the 10-year Treasury is in the 4% range, which is dramatically higher than it was a year ago. However, when you look back at the history of interest rates, where we are today is still very low by historical standards. Even if you were to eliminate the spike in interest rates in the early 80s, the long-term average 10-year Treasury is about 5%. So in many ways, what we're seeing today is a movement back toward normal interest rates from the abnormally low interest rate climate that we've had over the last 10 years. Now I'm going to take a couple minutes to talk about where I see the hospitality sector going through the remainder of this year and into the next. Consumer confidence remains in a good range to support travel and tourism. And after spiking earlier this year, airline fares have begun to come back down, which is a positive driver of travel. The U.S. Travel Association expects domestic leisure travel to fully recover this year, and that will be followed by a recovery of domestic business travel in 2023. That should support the continued recovery of hotel occupancies. The limited service sector has already fully recovered, but the full service sector, which is more dependent on business travelers, still has a ways to go. I expect that because people have gotten through the shock and major challenges of COVID, business travel will largely revive over the course of 2023. I'm already seeing conferences and other business event attendance recover very quickly. On a more focused level, the Florida market has made good headway over the last couple years. Although the Florida markets have not fully recovered to pre-pandemic levels, they have moved back into the right range. The momentum suggests that in 2023, the Florida hospitality market could be back in alignment with the peak level performance we saw in 2019. More importantly, the average daily rate is higher than it was before the pandemic, and that's supporting overall RevPAR growth. The ADR in Miami is nearly 30% higher than it was before the pandemic. West Palm Beach is 34% higher, and Fort Lauderdale is about 21% higher than it was in 2019. The Central Florida markets of Orlando and Tampa have also made strong gains, up 15 and 22% respectively, while Jacksonville is up close to 17%. All of these rates have grown faster than the US average overall. But RevPAR is where the rubber hits the road, and all of the markets in Florida, despite some areas not being fully back to pre-pandemic occupancy levels, are well into positive territory in 2022. RevPAR gains have been weakest in Orlando, which are only 4.5% higher than they were in 2019, but RevPAR in other Florida markets, including Jacksonville and Southeast Florida, are up anywhere between 15 to 25%. Now, to speak very briefly on the hotel sales climate, Florida transaction activity is nearly 80% higher than it was in 2019. When you look at the per key pricing, momentum has been positive also. On a year-over-year basis, pricing in most Florida markets is up. The sole exception being Miami, which had a particularly good bounce last year and has normalized a bit this year. Fort Lauderdale is up by nearly 6% on a year-over-year basis, while West Palm Beach is up over 11% on a year-over-year basis. Orlando pricing has climbed by 8% from last year, while Tampa and Jacksonville are well over 20% appreciation. Overall, the hospitality sector has honestly outperformed expectations, especially in Florida. The headwinds generated by the pandemic are mostly behind us, but yes, there will be some challenges created by a prospective recession in 2023. However, the significant pool of savings that people accumulated over the last few years, together with some cabin fever tendencies and increasing spending on services relative to goods, suggests that travel and tourism over the next year will remain strong. In addition, as liability risks brought on by the pandemic abate, businesses will likely put salespeople and business leaders back on the road in 2023, supporting the business travel segment. That will give the sector another shot in the arm. From an investment standpoint, the outlook for the hospitality sector also remains robust. There will absolutely be bumps in the road ahead and new challenges to face. But the hospitality sector has already demonstrated its durability, and there are a lot of opportunities for investors to continue to expand, especially when the positive longer-term outlook for this industry is considered. That bodes well for the market and should keep investors busy in the coming year, despite higher interest rates and any impending recessionary headwinds. Thank you for inviting me to be part of this event this year. I'm sorry I couldn't be there in person. Hopefully this video gives you some insights on what to expect. And as always, keep your eyes on the horizon.